Imagine being able to retire comfortably, secure in the knowledge that income from your stocks will take care of your expenses. To some, this sounds like a pipe dream. There are some, though, who have cracked the code, earning thousands from their investments each week. So, how are the professionals making millions from the share market? It turns out there are three main approaches you can take. It all comes down to how much you are willing to risk and how long you want to wait to amass your fortune. Let's look at how a beginner can go from a few $100s to making over $18,000 per week. What if you don't want to wait for years to start amassing your fortune? You might be surprised to learn that you can get rich fairly quickly. You don't even need a huge amount to start with. If this sounds good, maybe you should consider becoming a day trader. The idea is simple. Start by analyzing the stock market and finding companies that are likely to have big swings in the share price. In the morning, you decide whether the share price will go up or down and position your account accordingly. Traders can then use leverage to boost their position size. If you use 100 times leverage, you can turn $500 into a $50,000 bet. At the end of the day, you close the trade and collect your earnings. For example, imagine you notice that Nvidia is due to release a key financial report. You expect that the company is going to reveal that they have earned huge profits from the AI boom. So at the start of the day, you use leverage to buy $50,000 worth of shares. As you expect, the report reveals excellent earnings, and the stock price soars 10%. At the end of the day, you close the trade having earned $5,000. For successful day traders, the sky is the limit. It's not uncommon for professionals to make thousands of dollars in a single day. Sometimes, it only takes a few hours for them to make a small fortune. But there is one big problem with this strategy. Day trading is widely regarded as one of the riskiest professions in the financial world. While winning trades can build you a fortune, a string of losses can wreak havoc on your account. Leverage can work against you, magnifying your losses. Returning to our example, imagine that the Nvidia report revealed that the company's earnings had fallen. The share price drops 10%, and you end up losing $5,000. A few big losses like that can wipe out your account and leave you in debt. So, what if you were happy to wait a little longer for the chance to get bigger gains with less risk? In this case, you might want to consider becoming a growth investor. In this case, you will need to spread your investment across several stocks. Picking the right mix of stocks is key. You want to focus on companies that have the potential to significantly increase in value over the coming years. Because of this, many growth investors focus on industries like technology and healthcare. For an example of the astonishing amounts of money this strategy can yield, imagine you invested $100,000 into Nvidia, Microsoft, Google, MicroStrategy, and Supermicro Computer Inc. 5 years ago. Today, that initial $500,000 would be worth over $5.2 million. You would have been earning over $1 million a year or $20,000 each week. Of course, though, this method also comes with its own set of risks. There is no guarantee that these companies will be able to continue this amazing performance into the future. Because of this, it's recommended that you spread your cash amongst a broad mix of growth companies. That way, if one stock turns sour, it won't crush your entire portfolio. You'll also need to know when a successful stock has finished its upward run so you can cash out your profits. But what if there was a way to make a regular income from your shares with minimal risk? More conservative investors often turn to dividends to try to build their income. Many companies use dividend payments to distribute some of their profits to shareholders. In effect, you get paid just for holding the stock. Even better, this cash flow is very reliable. Even during a market downturn, you'll still be able to get money from your dividend stocks. For example, Coca-Cola has had its dividend for 53 years and has never missed a payment. In fact, the company routinely increases the amount it gives to shareholders. While this might seem like a free money hack, dividend investing has a few downsides. First, dividends are most popular among established companies. Because of this, their share price won't increase as quickly as growth companies like Nvidia. The biggest issue, though, is the amount of money it takes to retire on dividends. The average US stock has a 4.1% dividend yield. To earn $1 million a year, you would have to invest over $24 million. So, which of these approaches should you use if you want to get $18,000 each week? Your best option is probably a mix of all three. For example, you might want to try a combination of day trading and growth investing to boost your portfolio size. Then, you can take some of your profits and invest in dividend stocks. This will grow your passive income and protect your growth portfolio against a market downturn. Whatever approach you take, you'll need to stick to it. For any new beginner, it's crucial to develop the discipline required to regularly save and invest in your share portfolio. Making thousands of dollars a week is going to take several years, but you should take pride in watching your portfolio grow week after week. So, how do you plan to get to $18,000 a week? Let us know in the comments below.